1997, a man with no telecommunications experience raised $20 million. By 1999, his company was worth $47 billion. By 2002, it was bankrupt. The company was Global Crossing, and it laid 100,000 miles of fiber optic cable across the ocean floor, enough cable to circle the Earth 4 times. This is the story of the largest infrastructure bet in history, a bet that destroyed $25 billion in shareholder value. But here's what makes it fascinating. Everyone involved was acting rationally. The logic was sound. The math checked out. And every decision made perfect sense at the time. So what went wrong? Let's go back to 1996. The internet is exploding. Traffic is doubling every 6 months. Everyone's online. Companies are moving to the web, and there's a problem. The pipes are too small. Think about it like this. You've got millions of new cars hitting the highway. But the highway was built for thousands. Something has to give. And in telecommunications, that something is bandwidth. The solution is fiber optic cable, glass strands thinner than human hair. That can carry data at the speed of light. Literally, each fiber can carry tens of thousands of phone calls, or stream thousands of movies. The technology exists. Someone just needs to build it. Enter Gary Winnick. He's 49 years old. He made money in junk bonds in the 1980s. He's got connections. He's got ambition. And he's got zero telecommunications experience. In 1997, he founds Global Crossing. The plan is audacious. Build a fiber optic network around the entire world. Connect every major city on Earth. Create the infrastructure for the internet age. The first project, Atlantic Crossing Quanto. 1. A cable from New York to London, across the Atlantic Ocean, 2.5 miles deep, 6,200 kilometers of glass fiber. This isn't easy engineering. You're dropping cable to the ocean floor, in freezing water, under enormous pressure, while avoiding underwater mountains and trenches. It's like threading a needle, in the dark, underwater. But Winnick has a vision, and Wall Street loves it. In August 1998, Global Crossing goes public. The stock opens at $19. It closes at $38. First day double, the company is worth $3.8 billion, and they haven't connected a single cable yet. By March 1999, the stock hits $64. The company is worth $38 billion. Then in February 2000, it peaks at $61 billion market cap. Remember, this is a company building underwater cables. It's worth more than General Motors, more than Boeing. The market is saying, whoever controls the pipes controls the future. And maybe they're right. But here's the thing about gold rushes. When everyone sees gold, everyone starts digging. Global Crossing isn't alone. Level 3 is building fiber networks across America. Quest is laying cable from coast to coast. 360 Networks is connecting Asia and Europe. Flag Telecom is building routes to India and China. Everyone's laying fiber. And here's where the logic seems perfect. Internet traffic is doubling every 6 months. If that continues, demand will be infinite. You literally cannot overbuild. There will always be more demand. This is called extrapolation, and it's about to destroy billions of dollars. But in 1999, nobody's thinking about that. They're thinking about bandwidth scarcity. In 1999, a T1 line, that's 1.5 megabits per second, costs $1,500 per month. That's incredibly expensive. Companies are desperate for bandwidth. The economics seem obvious. Build capacity. Prices are high. Demand is infinite. So Global Crossing keeps building. They lay cable across the Pacific, from California to Japan. They build Pan-American Crossing, from the US to Latin America. They construct Mid-Atlantic Crossing, more routes to Europe. Each cable costs hundreds of millions of dollars, sometimes over $1 billion. And here's what's fascinating. Wall Street analysts are cheering them on. Not enough capacity. Build faster. First mover advantage is everything. Goldman Sachs has a $120 price target on the stock. Salomon Smith Barney says it's going to $150. These aren't random bloggers. These are the smartest people on Wall Street. And they're all saying, build more. Now here's where it gets really interesting. Global Crossing discovers something called IRU swaps. IRU stands for indefeasible right of use. It's a fancy way of saying permanent capacity rental. Here's how it works. Global Crossing sells 100 million of capacity on their network to, say, Quest. Quest pays $100 million cash today. In exchange, Quest gets to use that capacity forever. Global Crossing books $100 million in revenue. Right now, even though the service will be delivered over 20 years. But it gets better. At the same time, Global Crossing buys 100 million of capacity from Quest. Same deal. Cash today. Service forever. So Global Crossing pays Quest $100 million. Quest pays Global Crossing $100 million. They trade checks. But here's the magic. Both companies book 100 million in revenue. Revenue goes up. Stock price goes up. Executives get bonuses. Everyone wins. Except nothing actually changed. They just traded assets. Like trading baseball cards and calling it a profitable business. But the accounting rules at the time said this was legal. So they did it. Again and again. Billions of dollars in IRU swaps. By 2000, IRU swaps represent a huge portion of Global Crossing's revenue. The company looks profitable. Growth looks explosive. And the stock keeps climbing. Meanwhile, here's what's actually happening. Total fiber capacity is growing at 100% per year. Internet traffic is growing at 50% per year. Wait. Read that again. Supply is growing faster than demand. For the first time in internet history, there's more fiber than the world needs, and nobody's noticing. By late 2000, something strange starts happening. Bandwidth prices are falling. Fast. Remember that T1 line that cost $500 a month? By late 2000, it's $800. By mid-2001, it's $400. By 2002, it's under $200. The price is falling 50% every year. For Global Crossing, this is a crisis. They built their business model on high prices. They borrowed billions assuming $500 per month pricing. But the market is collapsing. And here's why. All that fiber everyone laid, most of it isn't even being used. It's called dark fiber. Fiber that's installed but not activated. Industry estimates say only 2 to 3% of fiber capacity is actually lit. Only 2 to 3%. That means 97% is sitting unused. You built 100 highways, and only 2 cars are driving. Now look at the balance sheets. Global Crossing has $12 billion in debt. Level 3 has $8 billion in debt. Quest has $26 billion in debt. These companies owe more than some countries, and their revenue is evaporating. The market starts to figure this out. In March 2000, the NASDAQ peaks. Tech stocks start falling. Investors get nervous. Global Crossing stock hits $60 in February 2000. By December 2000, it's $25. By March 2001, it's $10. By August 2001, it's $3. The company has lost 95% of its value, but they're still building cable, still laying fiber, still doing IRU swaps. Because here's the trap. They've already committed to these projects. They've signed contracts. They've borrowed the money. They can't stop. Stopping would mean admitting the strategy was wrong, admitting the fiber was unnecessary, admitting the debt is unpayable. So they keep going. Meanwhile, the executives are selling. Gary Winnick, the founder, sells $734 million in stock. Before the crash, $734 million, while telling shareholders to hold, while saying the company is undervalued, while building more capacity. Other executives sell hundreds of millions more. The employees? They're encouraged to hold, to believe in the vision. Many have their retirement savings in company stock. They're going to lose everything. By late 2001, the walls are closing in. Bandwidth prices keep falling. Revenue keeps shrinking. And the debt keeps growing. Global Crossing needs to make interest payments. But there's no cash. They try to raise money. Nobody's lending. They try to sell assets. Nobody's buying. They try to merge with other telecom companies. But everyone's in the same boat. Everyone's drowning. And there are no lifeboats. On January 28, 2002, Global Crossing files for bankruptcy. $25.5 billion in liabilities. The fourth largest bankruptcy in U.S. history at the time. 40,000 employees worldwide. Most lose their jobs. Shareholders lose everything. Bondholders get pennies on the dollar. Then the investigations start. The SEC looks into the IRU swaps. Congress holds hearings. Were the revenues real? Was this accounting fraud? Did executives know and hide it? The same accounting firm that audited Global Crossing? Arthur Andersen. The same firm that audited Enron. The same firm that would collapse months later. But here's what's important to understand. The IRU swaps were technically legal under the accounting rules at the time. Questionable? Yes. Misleading? Absolutely. But legal? This wasn't one company making one mistake. This was an entire industry making the same mistake, at the same time, for the same reasons. Global Crossing goes bankrupt in January 2002. WorldCom, $103 billion bankruptcy, July 2002. Adelphia, $24 billion bankruptcy, June 2002. XO Communications, $3 billion bankruptcy, June 2002. NTL, $13 billion bankruptcy, May 2002. Over $200 billion in telecom bankruptcies. In 1 year. What happened? The math is actually simple. They built capacity for the demand they predicted. But the demand never came. Internet traffic did grow, just not at the rate they expected. Traffic didn't double every 6 months. It grew about 50% per year. Still fast, but not fast enough to absorb all that fiber. But here's the deeper question. Why did everyone make the same mistake? And the answer is incentives. If you're a telecom CEO in 1999, what are your incentives? Your stock price is based on growth. Growth means building capacity. Building capacity means borrowing money. Borrowing money is easy because your stock is high. Your bonus is tied to stock price. So you build. Your competitors are building. If you don't build, you lose market share. Analysts say you're not aggressive enough. Your stock falls. You get fired. So you build. What about the analysts covering these stocks? They work for investment banks. Investment banks make money when telecom companies build networks. That's equipment sales. Borrow money. That's debt underwriting fees. Merge with each other. That's M&A fees. Go public. That's IPO fees. So analysts have every incentive to say, build more. And that's exactly what they said. What about investors? In 1999, everyone's making money. Your neighbor made 200% on Cisco. Your cousin made 500% on AOL. If you're not in tech stocks, you're missing out. FOMO is real. So you invest, and you don't ask hard questions. Because asking hard questions means missing the rally. Everyone had an incentive to keep building. Nobody had an incentive to stop and ask, do we really need this much fiber? The answer was no. The world didn't need that much capacity. Not in 2000. Not in 2005. Not even in 2010. Some estimates say we didn't use all the fiber laid during the boom until 2015. 15 years. That's how far ahead they built. They built the infrastructure for a future that took 15 years to arrive. But they borrowed money on a 5-year timeline. The math doesn't work. It never did. So what happened to Global Crossing? The company emerges from bankruptcy in 2003. Smaller. Different ownership. Most of the debt is wiped out. But here's the ironic part. The networks still exist. The cables are still on the ocean floor, still carrying data, still working. The technology was fine. The infrastructure was real. The engineering was solid. They just built too much, too fast, with too much debt. Today, we use that fiber. Every video you stream, every email you send, every website you visit, it's traveling through cables, some of them laid by Global Crossing. The infrastructure was ahead of its time. The business model was not. What about Gary Winnick? He kept his $734 million, never charged with a crime. The insider selling was legal. Questionable? Absolutely. But legal. He lost money too. His remaining shares became worthless. But he walked away with more money than most people make in 100 lifetimes. The employees weren't so lucky. 40,000 people lost their jobs. Many lost their retirement savings. They were encouraged to hold company stock. They believed in the vision. They lost everything. After the telecom bankruptcies, rules changed. The SEC banned IRU swaps as immediate revenue. Arthur Andersen collapsed. Sarbanes-Oxley passed. New accounting rules. New rules for insider selling. New rules for stock options. The system learned. Slowly. Expensively. But here's what we should take from this. It's going to happen again. Not with fiber optic cables, but with something else. Maybe it's data centers. Maybe it's AI infrastructure. Maybe it's cloud computing. Maybe it's something we haven't invented yet. Because the underlying pattern doesn't change. New technology emerges. Growth looks exponential. Everyone extrapolates current trends forever. Investors pile in. Builders overbuild. Prices collapse. Bankruptcies follow. The mistake isn't believing in the technology. The technology was real. The internet did change everything. Fiber optics did revolutionize communication. The mistake is believing that exponential growth continues forever. Technology adoption follows an S-curve. Fast growth at first. Then it slows. Then it plateaus. Always. But when you're in the fast growth phase, it feels like it will never end. Doubling every 6 months becomes your baseline expectation. You build for that future. You borrow for that future. And when growth merely stays high instead of exponential, you go bankrupt. Here's another lesson. Unit economics always matter. Always. It doesn't matter how fast you're growing. If you lose money on every customer, you can't make it up in volume. Global Crossing was selling bandwidth for less than it cost to build and maintain. That's a problem. A big problem. No amount of growth fixes that. And debt accelerates everything. In good times, it makes you rich. In bad times, it destroys you. Global Crossing borrowed billions. When bandwidth prices were high, this looked genius. When prices collapsed, it meant bankruptcy. Without debt, they might have survived. Scaled back, adjusted, adapted. With $12 billion in debt, no chance. But the deepest lesson is about incentives. Everyone involved had incentives to keep building. CEOs wanted stock options to pay out. Analysts wanted banking fees. Investors wanted to ride the momentum. Nobody had an incentive to stop and ask, is this sustainable? The people who could have asked that question, they got fired or ignored. Because in a bubble, pessimists are considered idiots until they're considered prophets. But that's after the crash. Look at those cables again. Miles of glass fiber. Sitting on the ocean floor, in total darkness. Carrying light at the speed of light. Connecting continents. Enabling everything we do online. The infrastructure was visionary. The timing was perfect. The technology was revolutionary. But they built the right thing in the wrong way. Too much, too fast, with too much debt, based on assumptions that didn't hold. Here's the final irony. We eventually needed all that capacity, just not in 2000. Not in 2005. Eventually. Global Crossing was right about the future. They were just early. And in business, early looks a lot like wrong, especially when you're 12 billion in debt. The internet kept growing. The fiber kept carrying data. The future Global Crossing predicted eventually arrived. They just didn't survive to see it. Sometimes being right isn't enough.